single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get a mobile travel guide, or California. When they go to Europe, they get the Michelin travel guide. People will hear a tip on a bus on some stock, and they'll put half their life savings before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions that program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If the company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anyone would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancies. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He can tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. So 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.